All right. Well, welcome everybody. Dustin TenBroeck here, president of Presidio Capital Management, here for our fifth episode of the Presidio Perspective. I know we have a bunch of attendees just signing on right now, but we're so happy that you could, of course, cancel your busy plans once again to join us. That joke got old about 3 weeks ago. I might stop telling it. I'm not quite sure when, but anyway, we're very glad to be here with you. We have a special guest, Mehernosh Engineer from Fidelity Investments is here. We're very glad to have him and listen to his perspective on what's going on. Before we get into the presentation, I just wanted to make a note. We've been doing this now. This is our fifth week coming out and sharing with you our perspective, viewpoints, and what we're looking at. I just wanted to let you guys know what our decision was behind all of that. And that our goal was, first and foremost, we're living through a very challenging time right now. And it's upset our financial plans, our portfolios, our work environment, our social life, our mental psyche. I mean, this has been a pretty traumatic event. And, with us not being in the office, we wanted to make sure first and foremost that we were just in front of you and that we're with you here every step of the way. And, no one has a crystal ball of how the future is going to play out and what's going to happen. So all we can do is try to take in more and more information. And we want to be with you every week, sharing with you our thoughts, our perspectives, our questions that we have about the future. We have our chat window and Q&A every time so that we can listen to your questions. We have some polls that we're going to share with you today. We look forward to hearing your feedback on that. And then we also bring in other industry experts. Okay, so these are experts in their field. Unfortunately, they don't have crystal balls either, but they do bring with them a lot of institutional knowledge and experience of some things we might expect in the future. And our goal, and we're working tirelessly at Presidio Capital Management to work hard to get the information. And look, I've said it before, information is in these three camps. We know what we know what we don't know, which is what Google's for. And most of the information always is in that camp of we don't know what we don't know. And so, there's a lot we know, but there's a lot more that we don't know. So we want to continuously be out here in front of you, sharing our perspectives, trying to get more knowledge and listening to you. So I'll share my screen here for the presentation today. So, like I said, we have a special guest. Nosh is joining us, and I've seen Nosh present before. I'm very excited that he can join us today. And I want to just spend a minute with you before to talk about a couple of my perspectives. So again, just remember that every investing always involves risk, including the potential loss of principal. So no strategy or product can assure success or protect against loss, and past performance is no guarantee of any future results. Okay, so we're not giving you any tax, legal, or investment advice through this webcast. Okay, so we're here to share our perspectives and some education collectively, but make sure you engage your own tax, legal, and investment professionals before making any decisions. And just a reminder, Mehernosh Engineer is a member of Fidelity Institutional. He's not affiliated with our firm or First Ally. So, today I just want to talk a little bit about, some of the headwinds that we're still tuning into at Presidio. And we'll invite our guest speaker to share his and maybe comment on some of these questions. The first thing I do want to touch upon is remember your portfolios, have an asset allocation where not all of your eggs are in that one proverbial basket. So, you have stocks, equity accounts, these tend to outperform over the long run. However, they could be very volatile, as we've seen in down times. Okay, your fixed income or your bonds are where you can find a little more potential for safety in your portfolio, a lot more price stability, as historically they have represented. Stocks tend to outperform bonds over the long run, but provide that stability to the portfolio. cash is the most stable investment. Of course, you're going to be the most impacted by inflation. And so cash represents, an opportunity, a future opportunity in your portfolio. So in times of great unknown of the direction of the market, holding a little bit more cash is providing you some stability and is also representing future buying opportunities that you might get to experience as investors. So I did want to talk a little bit. I know I'm not going to go over this too long because I know our guest speaker today is going to talk about this in great detail, but we are preparing to deal with this crisis for the long run. And this is one of our concerns as it relates to the economy and the stock market. So this slide there's a lot going on here. So it's showing here, this is from Morgan Stanley research team, showing how cases in the US have kind of hit their peak right around now is what we're hearing, right? Reaching that plateau. So you had an early spike in the western states of Washington, in New York, Massachusetts, followed by the rest of the country. And we're hoping that we're reaching this plateau right now and that those cases will start to dwindle into the summer months. Testing capabilities are very fluid, and we're finding out more potential timelines for those and who they're going to be available to. By the way, this is just one of many potential outcomes or timelines that is out there. This is not what's going to happen. This is just one perspective as to what this timeline might look like. So, we're looking for the first wave, return to work for looking at sometime in June based on this timeline. So, thinking about continuing these webcasts for another, 8 to 10 weeks is something that we're prepared to do. And it might be a lot longer for us. They say that, the non-essential workers, et cetera, different parts of the economy are going to return to work likely in stages. And so that, second wave probably isn't going to come until the midsummer months, late July or potentially August. We're hoping that schools can resume next year, but this right here, this potential second wave of infections is what, historically you've seen in pandemics like this. And, our question is, the only thing that we've seen so far to effectively combat this virus and its spread is to shelter in place. And although I think that our economy and our society will be much better prepared to do that, obviously with some lead time, it still can't be completely discounted that should have some significant impact or effect on our economy and the stock market. So, and of course, when we're looking at the stock market, they're always looking 6 to 9 months ahead. And so, we might see volatility pick up if this is something that starts dominating the headlines as people look to. So, we know that social distancing reductions or, the social distancing norms as we see them today are probably going to be in place for the next couple months. And you're going to start to see some reductions, hopefully in June as we get into the summer months. But that some elements of these social distancing measures, when we talk about a return to normal, it's not going to be like it was in January. There's still going to be a lot of social distancing norms and things that we have to do when we go to reopen the economy until a vaccine is widely available and taken, right? It's another challenge. So, the return to work for non-essential workers is expected to happen in stages. So I think that our guest again has a lot more information and perspective on this, but we should likely expect to reduce levels of activity, until a vaccine is widely distributed, and we have other means of containing this disease, other than what we've proven to be successful so far. And if we look at, Robert Redfield, who's the director for the CDC, and Anthony Fauci, director of the National Institute of Allergy and Infectious Disease. I'm sure you've seen him on the news plenty. Robert says the virus is very likely to come back very significantly in the next coronavirus season, which will happen next December, January, February. We have Anthony Fauci telling us it's highly likely that we will have, and I don't know whether you want to call it a second wave, but we will have a return of infections as we get into the next season. So, for us, this is something that we expect. We talk about, don't just plan for the unexpected. right? What are the big three? Inflation, taxes, market crashes. We know that all these three things are going to occur. We plan for them, we account for them. So this is, again, in that kind of same camp. Let's not just plan for the unexpected, but what about the expected? So that's what is one of the headwinds that we are very focused on at Presidio. The next, and it's going to be kind of dictated by that first headwind, is how affected is the U.S. consumer going to be? You know, we've seen some alarming statistics over the last couple of weeks that were pulled from earlier this year that found that 69% of Americans have less than $1,000 in savings. And 78% of American workers polled said they live paycheck to paycheck. And, you know, right now you're not, you have a lot of those workers not receiving a paycheck, or at least not a vision of when those paychecks are going to come into the future. So that's a big unknown, you know, and very concerning is what we saw reported by CNN is that a third of renters did not pay their rent in April. That's the first month of this thing. A third of renters did not pay their rent in April. And so you are going to see some trickle up economics, we assume, of when that starts hitting landlord and property owners, and what that could mean, you know, for the economy as well. You know, we are, you know, estimates of unemployment. Again, our guest speaker is going to talk more about that, but they're going to be pretty high here for this next quarter. Our concern is, okay, before, during, but what about after? How does the U.S. consumer emerge after this crisis is over? And I think back to times of 9/11 when we had a very scared U.S. consumer, for rightfully so. And it took a while for the U.S. consumer to kind of get back out there and start spending. And so how damaged are we going to be financially? So, you know, how much debt are we going to have in the U.S. households? You know, that they need to pay down, they need to build up savings. You know, this is money that's not being spent or put into the U.S. economy. And also, what is the psychological impact that we're going to have? And it's sobering and so sad to think about not only how long this is going to continue and how we might have to adjust to this new way of life for seemingly a long time, but the death toll is going to be significant. And what is the psychological impact that is going to have on us? Now, again, Americans have been very resilient in the past. Human beings in general as a species are very resilient. We hate change, we fear it, but we adapt very well to the new circumstances. So, you know, I won't discount the human ingenuity and drive to succeed and live, especially here in this country, but it is something that we are concerned about in the short term. So I just wanted to share a couple of my thoughts. I'm very interested to hear what our guest speaker has to say here. I'll save that one for next time. So coming back to the Oracle of Omaha, you know, in these times, I've been telling you week after week, you're going to see some of the best weeks on record, some of the worst weeks on record. I think it's not going on edge to say that volatility in the stock market is going to continue through this year. And we want to be patient. Right? And the stock market is a wonderfully efficient mechanism for transferring wealth from the impatient to the patient. So with that, I'm going to turn it over to our guest speaker. So Nosh, I think you want to share your screen and unmute and join us here.
Thank you, Dustin. And let me start the share screen process. So since February of 14th, which was Valentine's Day, today is tax day, we've seen a lot of amount of unprecedented volatility. And that comes accompanied with a lot of uncertainty also. And all of this combined usually elicits an emotional response of fear that usually leads to irrational decisions of selling out or doing something very radical. And that's exactly what Warren Buffett was alluding to. And what we wanted to do today in the discussion that we are going to have is break it up into three parts. So in the first part, view the corona crisis as we've been watching it over the last 2 months, what it means in terms on the healthcare side, what it implies on the economic side, and then finally, what recommendations we are giving to our clients in this kind of an economic environment. So we've been utilizing this website very extensively to monitor the entire virus crisis. And to get to it, you simply need to type in the word worldometer, coronavirus, and it should take you to this website. What we do like about this website is, firstly, it's set up by third-party independent research people. So no political affiliation, no country affiliation. All that they're doing is aggregating data from across the world and presenting it out here. And when we look at the data, you'll find quite a bit of detail in there. So it's broken down by country, total cases, new cases, fatalities, active cases, and even some testing data that they've added over the last 2 weeks. And that allows us to follow the story, what's working, what's not working. So let's start with China, where the virus originated in the city of Wuhan. So firstly, the city of Wuhan has a population of 11 million people, so densely populated urban area. The first cases are found about January 15th. By the time we get to the end of January, the number of cases has escalated to 10,000. So the Chinese authorities realized two things. One, this is an extremely contagious virus. And secondly, if it's not stopped, it can lead to a very serious human tragedy. So the first course of action was to stop the spread of the virus. So easiest thing, quarantine the entire city of 11 million people. Once they did that, the second course of action was, let's identify who has been infected, take them out of the system, give them medical assistance. So literally 6 weeks of aggressive testing and monitoring. And then, as we can see from the middle of March, the total number of cases has been flat. The daily new cases has literally gone down to 0. And when we talk about China, literally we are talking about South Korea, Singapore, Hong Kong, Taiwan. Very similar templates. Now let's go back and take a look at Europe, and we can either take a look at Italy or Spain. And the first thing you'll notice is that the total number of cases, the total number of fatalities across Europe has been significantly higher than in China. The reason being, both Italy and Spain are very much dependent upon tourism. So tourism makes up close to about a quarter of the economies. So they were very reluctant to shut down their entire economy because, yes, it would lead to a collapse in growth. So they kept it open until they realized, so until March 21st, when the daily new cases ramped up to 6,500. That's when the Italian authorities decided we do need to enforce a vigorous quarantine. And since then, you can see over the last 3 weeks, the count as of yesterday has actually come down to less than 3,000. So give it about 2 more weeks and probably the count will start getting less than 1,000, very manageable in a sense. Now let's go back and take a look at the US. So the total number of cases has escalated very significantly across the US over the last month. And there are different reasons for it. So let's look at the history of how things have developed in the US. So the first cluster of cases are detected in King County, right outside Seattle in the state of Washington. And they very much follow the Chinese template. So quarantine the entire county. The second cluster of cases is located in Santa Clara County, which is right adjacent to where I live in the San Francisco Bay Area. And Governor Newsom not only quarantines that county, but the entire San Francisco Bay Area, so 6 counties, 7 million people. I would say the best political decision that I've seen in the last 30 years. And we can see that California, despite being the most populous state, has a count which is almost 5th on the list, and I expect it to keep dropping lower. Now, at the same time that California imposes shelter in place, New York also passes a similar law, but it doesn't enforce it. Now we know that New York City has a population of about 8 million people. So densely populated urban area, which allowed for the spread of the virus in a very significant manner. And then you have the adjacent state of New Jersey. A lot of people commute in heavily populated trains, so that led to the spread. But a lot of people are surprised why are states on the East Coast and the Midwest starting to show up in a very big way. And that has a totally different reason. So let's look into that. And this is something very fascinating. So during the month of February and March, a lot of kids from the East Coast and the Midwest went down to Florida and Louisiana for their spring break. So what this company did was they went to a popular beach in Florida and they said, let's note down all the mobile phone numbers on that beach over a 7-day period. And then they said, let's track these numbers where they land up 2 weeks and 4 weeks down the road. And what it essentially tells us is that these kids, when they went back either to their dorms or more likely to their parents' place, they were enabling the spread of the virus across the East Coast and the Midwest. Now, going back to the state list, what we can also see is that the count in Florida has also been increasing. And there's another reason for it, and that is because Florida has a very high concentration of retirees. So literally 22% of the population is more than the age of 65. And that's the segment of the population which is also extremely vulnerable to the virus. So Florida is a risk state that we are watching over the next 2 or 3 weeks. The other state that we are watching is Texas. So what you might see is that Texas is the second most populous state, but it has a very low count. And that's not because they've done the right things. They've actually done the wrong things so far, which is they've barely tested their population. So if you look at the total number of tests at 151,000, that looks like a high number. But that's not the way to look at things. You need to look at the number of tests per million people. And you can see Texas is at 5,400. Louisiana is actually testing at a very similar rate to New York at 26,000 per million people. So once Texas starts ramping up its testing schedule, we will see a whole lot of cases also coming through. So these would be the two risks that we are watching out for. Now, how are we looking at this entire global picture? And to help us do that, JP Morgan has laid out quite a nice schematic diagram. So this is the picture as of March 15th. So China is on the other side of the curve, Korea, Italy, Iran getting very close to the peak, the rest of the Western world and parts of Asia Pacific just starting its journey of what we call as the journey of pain. 15 days forward to the end of March, we can see China and Korea are past the peak, Singapore, Italy, Spain getting very close to the peak. The US and UK have risen up the curve. And then as of last weekend, China, Korea, Germany, Spain, Italy, Singapore, close to the peak, if not past the peak. The US has about 2 or 3 weeks yet to go. So putting all this together, both Deutsche Bank and JP Morgan came out with a few dates to expect the peak in the curve in a sense. And for the US, they've given us 3 dates. So the 30th April date is more of a political wishful thinking date. The more likely date when we actually peak out and we start seeing a bending of the curve, if we follow the template in China, which is quarantine accompanied by aggressive testing, would be in the second half of May. And if we slip up on those measures, it might actually extend into June. So keep these timelines as we go through the entire process. And there's something interesting that I wanted to show, especially since we are in California. So yesterday, Governor Newsom came out with the roadmap to modify the stay-at-home order. And there was a graph in it which was very telling as to how they were looking at this crisis. So firstly, when they say phase 1 surge capacity, what they are telling us is that there are 50,000 beds available today in the state of California to handle the virus infection. Now, as we sit today, you can see the number of infections or the hospitalizations are somewhere in the 7 to 8 to 10,000 range, slowly starting to increase. But at the May 1st point, if we were to open up our entire California economy, go back to normal with no social distancing, no quarantine, very likely it'll start ramping up exponentially and we'll run out of capacity by the middle of May, leading to a human tragedy. Rather, the roadmap today is to track this curve, see where it bends out, very likely by middle of May or towards the end of May, they will feel comfortable about opening up the California economy. So this is something similar. A lot of states might also start adopting, and that needs to be seen over the coming weeks. But let's change topics and talk a little bit more about the economy today. So starting with China. So 3 weeks ago, the authorities in China actually gave the green light to opening up all manufacturing centers. As of last Friday, the final big restriction of allowing the population to move out of the city was also given. So literally, China is walking towards normalcy. So as we sit today, fourth quarter GDP in China was growing at about 6%. In the first quarter, February and March, total economic shutdown. So we expect the economy to drop very significantly by 10 percentage points down to about -4 to -5%. With all the indicators that we are looking at today, things like power production, coal usage, traffic levels, manufacturing capabilities, pollution levels, what it's telling us is that China on average is at about 85% of normalcy, and it may take another 4 to 8 weeks to get back to full normalcy. So looking at all of these indicators, what it's telling us is that a recovery has started taking place. It's quite vigorous in nature. And by the time we get to the end of the first half, the Chinese economy should be on a path towards growing at about a 5% rate. Now let's look at the US side of things. So first quarter, no real impact on the economy. Having said that, we had a weak retail sales number today, which is telling us that maybe we started contracting a little bit towards the end of the quarter. So we might get a print somewhere between 0 to -1%. The big pain is going to come in the second quarter. And estimates out there range between -5 to -30. Our estimate today, based on the retail sales, the number of people who've been unemployed, tells us it'll be somewhere between -15 to -20%. Now, with the equity drop of 30 to 35%, what it is telling us is that the market has already priced in a lot of this bad news coming in the second quarter. What the market is uncertain about today is the nature of the recovery in the third quarter. And that uncertainty is coming from two factors. One, as we mentioned, on the healthcare side of things. Two, as Dustin correctly mentioned, is will consumer behavior change because of this event? So to overcome some of the negativity that will get built up by the event, let's look at what fiscal measures have been passed by the government so far. So we know that the CARES Act was passed 2 weeks ago. It's about $2.2 trillion. US GDP is about $21.6 trillion. So literally, it's about 10% of GDP. Very similar to what we saw in 2008 and 9. Now, what's in this 2.2 trillion? So firstly, there's 500 billion for consumers. So if you're making a paycheck of less than $75,000 and you've been laid off, you get a one-time payment of $1,200. If you're a family of 4, you get a one-time payment of $3,400. Now the question to ask is, how long will that last? So what we did was we went and looked at average salaries. So New York average salary is about $72,500. California is about $65,500. North Carolina at the bottom is about $51,000. So give or take, this $3,400 will last for about 3 to 5 weeks. So literally, we are getting to the end of it, in a sense, towards the end of this month. And we'll come and talk about that in a minute. The second program is what they call as the Small Business Grant Program, also called the Payroll Protection Program. Similarly, if you're running, let's say, a small accounting firm, a lawyer firm, what they're telling you is that go fill a form, don't lay off your people, and you can take a grant from the government to make that payroll. As of today, what the US Treasury is telling us is that 300 billion of that 367 has already been given out, and this program will run out of money probably by midnight today, if not tomorrow. And we'll get back to that again. But let's look at the corporate lending facility. So what the US Treasury does out here is that it takes 425 billion, gives it to the Federal Reserve to set up what they call as a special purpose vehicle. The Federal Reserve then leverages up that money 8 times to get to about $4 trillion. And then it starts utilizing it to buy corporate loans, corporate bonds, mortgages, even municipal bonds. So essentially, the Federal Reserve starts giving out a lot of liquidity into the real economy. So we should see some significant impact of it in the weeks and months to come. And then let's look at what the other 75 billion is for. So 50 billion goes to the airlines, 8 billion to air cargo, which is nothing but FedEx and UPS, and 17 billion towards national defense, which is nothing but Boeing. But what I do like about this package is 2 things. One, there is exclusively 150 billion being earmarked for healthcare, of which 100 billion goes towards hospitals. So this will help to refurbish facilities, expand facilities, even provide funds for new facilities. And then there is an additional 150 billion for state and local governments to pay for unemployment costs and healthcare. Now, as I mentioned earlier, the 2 big facilities, the household and the small business, they are not going to be adequate. So Congress and Senate, both of them are now thinking about a second version of the CARES Act, which will be smaller in size, about 500 billion. So 250 billion goes to small businesses, 100 billion to hospitals, and 150 billion for state and local governments. So all of this money, which will be distributed over the coming weeks and months, will probably help us to tide out till about the end of May, probably till the middle of June. And then the question comes about, how do we go about creating a vigorous recovery from the extremely big slump that we are going to experience in the second quarter? And that brings us to the fiscal infrastructure spending. So 2 weeks ago, President Trump came out and said that he wants to do a $2 trillion fiscal infrastructure project. Nothing surprising about it. He said that over the last 3 to 4 years. What was surprising is that Speaker Pelosi actually agreed to it. So let's first look at the timeline and then look at the impact of if this comes to pass. So Senate and Congress both come back after the recess next Monday on the 20th. Very likely they'll take about 4 to 6 weeks to pass this package. Once it passes, it takes about a quarter for it to actually get implemented in the real economy. So optimistically speaking, we are looking at the impact of this package to start taking place towards the end of September, more likely beginning of the fourth quarter. So it is being targeted from an election perspective. But to us, it has a lot of importance. So firstly, this is a true stimulative package, and its impact will not only be for 1 or 2 quarters, very likely for 3 to 4 years. So that's the first thing. Similarly, it'll also impact the earnings of companies. The other thing that we're looking at is, what does infrastructure mean? Does it mean roads, rails, bridges? Does it mean education? Does it mean healthcare? Or does it actually mean the digital economy? Our thinking is that they are going to spend a big percentage of it on the digital economy. So sitting today, we are having this conversation either via WebEx or Zoom, which is nothing but telecommuting. But this facility is not available throughout the US because people either don't have the internet or they just don't have the bandwidth. So we do need to build out that infrastructure. Once we build out that infrastructure, it can be utilized for several key purposes. So firstly, ability to work from home. Secondly, you also have the ability to get your education from home. And thirdly, the most important one being telemedicine. So all of us who live in California, if you have your healthcare insurer as United or Kaiser, they've been rolling out telemedicine over the last 18 months. So that's going to start rolling out across the nation. And then very likely the government may also make an investment in 5G infrastructure utilizing this fiscal infrastructure project. And that will also be very advantageous in the years to come because it will enable things like autonomous driving, doing things on agricultural land, controlling drones, and finally, taking telemedicine one step forward towards remote automated surgeries. So keep an eye out on this infrastructure package as we go through the summer. Which brings us to the final question. What should we be doing as investors? So the first thing I tell clients is focus on your health, focus on your family. If you're still concerned about things, pick up the phone, have a conversation with Dustin. And the reason I say that is because we are viewing this virus crisis as a temporary, transitory, optimistically a 1-quarter event, realistically a 2-quarter event. This is not the first time nor the last time that this event has happened. If we actually go back just 2 decades, this is the 7th instance of a virus flu-like global event. So this too shall pass as we overcome similar events. But coming to the asset allocation, looking at the uncertainty on the healthcare side of things, the uncertainty on the fiscal monetary side of things, and then once this virus crisis is over, we'll start hearing a lot of rhetoric from the politicians, which may add to the volatility. So considering all of this, we've been tilting our hand more towards the conservative side of things. And when we say conservative, what we are really talking about is owning high quality assets across the board. So in fixed income, focus on investment grade bonds, which is US Treasuries, mortgages, and highly rated credits like Walmart, AT&T, Microsoft, Amazon, all of those. On the equity side, more large cap funds in a sense. And then if you ask me the question, where do you see the best risk reward today? Our answer would be very much in international and emerging markets. And it's nothing to do with the virus crisis. It's everything to do with two big factors. The first one being cheaper valuations. The second one being higher structural growth. So let me stop there and open it up for questions. Thank you.
Thank you, Nosh. So everybody out there, hopefully you can see me. Good. So thank you for that, Nosh. I'll have a couple comments and questions, and then everybody, if you want to open that Q&A window, we've had a couple questions come in. I'll give you a second to put those out. So, I was going to share a slide. Let's see if I can come back to the one that I skipped over here. You talked about how we hadn't seen this before, or that we had seen this before, rather. And, one of the things that, we notice, if you look back at the S&P 500 earnings history, so this is a chart over the last 150 years. It was updated as of September 19th, showing the earnings history of the S&P 500 on earnings per share basis, adjusted for inflation. So what you notice is a trend to the upward, and we're adjusting for inflation here. So if you look back in 1980, the stock market was producing earnings of $50 a share. At the end of September of last year, it was $133 a share. So, our economy is growing and has been more lucrative as a whole for investors. So again, this is adjusted for inflation, meaning that the economy of today is 165%, more productive than what you saw in earnings 40 years ago, right? So when we're comparing events in the past, we have to understand that we are looking at a very different world than when we look at the world 1990, 1980, 1950s, wherever you go. You have to kind of put yourself into that place and how different it was. One of the things we did experience, they talk about, I remember in 2009 during the housing crisis, they talk about a once in a, lifetime, or every black swan, every 100-year event. This is an every 100-year event. We did have the influenza crisis exactly 100 years ago. And when I look back at this chart here, you saw earnings go to basically zero over that 2-year period in the economy. I mean, we have seen a pandemic, and that one was affected, I think, close to 25% of the population of the world, and had just a huge death toll, obviously. And so that was a very different world going back there. But, you saw that. And then what emerged from there was the Roaring 20s, which is one of the best decades on record. What was one of the best decades on record this last 10 years we had coming out of the housing crisis. So, I think, I really appreciate Nosh's balanced view of talking about both the tailwinds and the headwinds, and looking at, from a practical lens of what we're dealing with. And, long-term investors, which are hopefully most of what you see in the stock market, if they have a bullish view of the future, again, you're buying the next 10 years of earnings. And if you look at the next 10 years, to Nosh's point about having one or two really bad quarters and maybe a hangover on the U.S. economy that could last a couple of years through a recession, it's still probably very positive. There's a lot of things, like I said, to be optimistic about the long-term views for our economy and the stock market. And Nosh touched on, technology, which is something we've been talking about for the last couple of years, of the paradigm shift that's going to happen. I mean, we've been talking about that in our Retirement 101 course, about the paradigm shift with teledoc, self-driving cars, et cetera, and I've been specifically talking about, hospitals and schools being institutions that could go virtual. And here we are kind of forced to do that. And so, I think that, if you look at this kind of graph of earnings, why does the market continue to go up during bad times? Well, again, we're looking at the next 10 years. And the next 10 years for our economy probably look pretty rosy. Is the next, 12 months going to be fun? Probably not. I have no idea. But so just, it's nice to look back over history and kind of take a look at some of those things. We're pretty resilient. So, Nosh, one of the questions I had for you when you were talking about Wuhan and the Chinese economy and how they've come back, I think you said 85%. What I did notice down there is that they had what were called negative sectors or something like that, where they specifically still listed a ban on cinemas, bars, gyms, restaurants, and sporting events. And for an economy like that of China's, which is still heavy in manufacturing and output, and exports, here in the U.S., we have a very consumer-driven economy. And if you don't open up, sporting events and bars, gyms, and restaurants, wouldn't we see a very different outcome as far as getting back to productivity than what you shared with us on Wuhan?
Yes. So having said that, if you this is what surprised me, and let me do a screen share again. And this is exactly what you're alluding to. And Governor Newsom alluded to it yesterday also, that some behaviors will have to change. And this is what caught me a little bit by surprise also. So there he says things will look a little bit different. So restaurants will likely reopen with fewer tables. Now, is that a business model which is actually viable or not? I don't know. But it actually tells me that if you want to eat the same meal from a given restaurant, you might actually just order it home, which gives a very different business opportunity in terms of things like Uber Eats and things of that nature. So maybe the restaurant doesn't actually see a drop in demand. It's just a change in habits which start taking place. And maybe that's temporary till we just get to a vaccine, which could be in 12 to 18 months' time. So these are all things which are in flux today. And some people say, let's just hold sporting events. If people fall sick, that's part of herd immunity. And then there are people on the other hand saying, we should be much more conservative, knowing that this could escalate into a healthcare crisis. Not being a medical practitioner, I can't tell you which side is right or wrong, but so far I would say erring on the side of being conservative has paid off for China, for the state of Washington, and for the state of California.
Excellent. Sorry, I was caught off guard by an excellent question posed by somebody out there. Will airlines finally get rid of the middle seat? I like that. Yeah, maybe this will lead into a lot more legroom. So good question out there from our attendee. Good. All right. So Nosh, maybe you can bear with me on some of the questions from the audience.
Yes, we got time. So take your time.
Wonderful. So one question is specifically to you. Are you familiar with the Time article reporting 2,500 urns being delivered to Wuhan on a daily basis? And do you have confidence in believing the news from China?
So let me frame that question differently and say, do we believe in all the data that comes out of China? Absolutely not. Having said that, there are ways to verify things that come out of China. So when China reported their export numbers and the import numbers this Monday, that is not something that they can fake because it takes place with other counterparties like South Korea, with Japan, with the US, right? So there's certain data at a much higher level that people can track. There are also hedge funds who watch a lot of these other metrics, which we call, which gives them a little bit of lead time and advantages. And what I'm talking about is literally pollution levels using satellites. There's also a service called TomTom, which monitors traffic levels across the world. So things like that, you can't really fake it because that's like third-party monitoring in a sense. So I don't have an answer whether those 2,500 urns are being created on a daily basis or not, but based on a whole host of data from independent third-party people, we can say its activity in China is roughly at about 85%. Now, are the number of deaths reported in China the actual number, or should I be adding a zero to it? I have no idea.
Yeah, okay. Let's see, we had another question. I'll field this, and if you want to add anything to it. So with the federal spending being distributed to support the CARES Act, how will this money impact the national debt? What are the future ramifications of increasing the national debt to a level that is well beyond our ability to repay or even reduce? So I'll kind of take the first part of that, Nosh,
Okay.
and I think I'll have you comment on our ability to repay and reduce. So again, we talk about this consistently, and I'm not going to stop talking about it because it's the absolute fact of investing and the experience we're going to have. The big three that we want to control and strategize against are inflation, taxes, and market crashes. And absolutely, you can do a lot of things with your portfolio to insulate yourself from a market crash or from inflation, and those will probably expose you to risk somewhere else in your portfolio. So it's quite a balancing act. All three of these forces want to make your money worth 40% less, and they will, given the wrong strategy. So, when you have a lot of debt that the government is taking on due to stimulating the economy in a bear market, well, there's only one way to effectively deal with that debt. The best way that you can deal with that for corporations, individuals, and a government is to have inflation. Something that we talked about in the last crisis that never materialized. But if you take a $400,000 mortgage on a home, and all of a sudden 10 years from now we've had inflation, and that is only worth $200,000 in today's money, or in that day's money, then you have made that debt worth less. And so when you borrow money in today and you pay it back with the future dollars, remember that because of inflation, money in the future is worth less. So it looks like a big number today, but we don't have to pay an inflation adjusted number. And the interest rates, by the way, are pretty low. So there's not a lot of interest that we're paying on that debt. So we don't really have a lot of concern of the U.S. economy's ability to pay for those reasons. The only way that I'm aware of for the government to get revenue is through taxation. And so if you are concerned about that, if we don't have the inflation, then the other thing that they're going to have to do is increase taxes. So those are your two options to dealing with debt for the economy, and the same thing for household owners. If you can't pay off your debts because we didn't have the inflation, you got to bring in more income. So, those are things that we're going to likely see. So quite a balancing act with these three. Nosh, do you have any other comments on that?
So the first thing I would say is I totally agree with your assessment of inflation and taxation. A wrinkle I would add is that it usually also comes about with a weaker currency. And a good hedge towards inflation in the past has been about buying commodities. So we've always seen dollar goes down, oil prices go up. In today's environment, where the entire energy market, if you look at oil, natural gas, significantly oversupplied. So what you're not going to get is commodity inflation. What it actually does is that it helps the consumers in the emerging markets like China and India to do much better. So your best hedge today versus a weaker dollar is to actually buy international and emerging markets. So that will lay off some of the risk that will come from higher prices and inflation in the US.
Yeah. So as for your portfolio, how you offset inflation. So with government spending and increase in debt levels, so you would forecast, higher inflation rates down the road.
Yes, absolutely.
Do you have any comments as to what sectors of the economy do you think are most insulated from COVID, tech seemingly being the most resilient right now?
I would put healthcare ahead of tech, and nothing to do with the virus crisis per se. But if you look at the demographics of the nation, today we have 52 million baby boomers above the age of 65. That number goes to 75 million over the next decade. So irrespective of what the politicians say or do, the demand for healthcare is going to increase. Now, as I mentioned in the Two CARES Act, there's going to be further funding for healthcare. Also, with this virus crisis, a lot of the emerging markets are also going to invest in healthcare infrastructure. So very positive for US medical device and equipment companies who are big exporters into the emerging market space. And finally, you get to the point of innovation, not just with this virus, but a whole host of diseases, therapies, especially obesity, diabetes, cancer, things of that nature are progressing. And that's where we see the bigger opportunities today.
Great, thank you. I'll do another review of the Q&A to see if there's anything else. We are going to launch a poll to the participants out there, so you should see it. So we have a poll today. Nosh, I'm going to let you submit your answer as well. So the first question we want to ask is, how confident are you that the stock market will be higher than it is today 2 years from now? Are we very confident, somewhat confident, not confident, or not sure? Second question is, how confident are you that the stock market will be higher than it is today 5 years from now? Again, very confident, somewhat confident, not, or not sure. And if the equity portion of your portfolio went down 35% from today's value, would you sell out of equities entirely, sell half your equity position, buy more, do nothing, fire your financial advisor? It's my favorite question here.
I filled out your survey, so.
Okay. All right. So we're pounding the pulse. We're about to have 2/3 of everybody answered so far. Quickly coming in. Give it another second as you deliberate. Let me see if we have any other expected intervention. So do you think that there's going to be a big variation in the eventual recovery geographically across the country?
I wouldn't say geographically it matters, because as of the present, all 51 states have shut down. Every state is dependent upon some other state in some capacity. So most governors will probably come to a decision at some point, in a sense, to say, we all agree, curves have started bending out in most of the hot spots. Let's start gradually opening. And it'll be more a factor of how aggressively we go about testing in some of the big hotspots. And the hotspots are nothing but urban, densely populated areas.
Okay, good. All right, I'm going to close the poll in the next 10 seconds or so. If anybody's out there, I do see we're still having some votes come in. All right, we have just about everybody. So 80% will end the poll. And I will share the results here. So how confident are we that the stock market is going to be higher in 2 years? So leading the way, we have 51% of us think that we are somewhat confident. Another 40 are very confident. Only 6% of those responded are not confident. And 2 of you out there are honest. Sorry, 2 of you are not sure. Just kidding. So how confident are you that the stock market will be higher than it is today 5 years from now? Here we see the confidence level increase to 75%. 17 are somewhat confident. Again, just 1 out there not confident, and also another 3 not sure. If the equity portion, I'm really glad to see the answer of this one. If the equity portion of your portfolio went down 35% from today's value, no one's going to fire their financial advisor. Well, that's a sigh of relief. Sell out of equities entirely, 2%. Sell half your equity position, 4%. Buy more, do nothing. And, our comments on this, absolutely, you want to make sure that when you're investing, this is just the question was posed about just the equity portion of your portfolio. So not all of your money down 35%, just thinking of the equity position. So inflation, taxes, market crashes was something we experienced. So, make sure you're talking with your financial advisor to assess your risk tolerance. If we're investing in equities that don't have any guarantee of not making money and losing value, that you might have to weather some bear markets and drawdowns. And so you want to make sure that, you get the appropriate portfolio to deal with these kinds of things. So, Nosh, thank you so much for joining us today. That was wonderful having you. We'll try to loop you in down the road, and as we're going to have some more information that we're going to need. So everybody, thank you so much for joining us. You can join us next week, Wednesday at 4 p.m. We're going to have Vice President and Chief Strategist from PIMCO Investment Management, who's going to join us next week. And as always, stay safe. And we look forward to seeing you in the future. Thanks, guys.